Now, if you're doing well enough in the self-employed field that you can pay cash for a house, you can ignore everything I'm about to say. But for the rest of us who are having to utilize a mortgage to get a home, this is something that's going to be very important. So I definitely want you to pay attention to this. So the way that it works is that they're always going to be looking at your... Welcome to the Home Goals Podcast, the ultimate guide for turning your home goals into a reality. I'm your host, Derek Thornton. Join us as we navigate the twists and turns of obtaining a home. We'll be offering expert tips, helping you avoid pitfalls, and championing your journey towards that cherished place to call home. In this week's episode, we will be discussing what it takes to buy a home when you are self-employed or you have an irregular income. This is something that is obviously very near and dear to my heart, being that I'm a realtor and our pay structure is basically 100% commission, right? So if you don't sell anything, you don't make anything, right? And so we have the definition of irregular incomes. We get 1099s instead of W-2s for our taxes, right? It's a lot of, you might have a month where you sell and make 10 grand in 1 month and then you don't sell anything for the next two, right? It's always up and down. You're kind of figuring out what it's going to look like. And so we're going to talk about what it takes or what a lender is really going to be looking at when you're trying to qualify for a home as a person who has an irregular income. This is something that I definitely want to talk through, especially now because I feel like it's relevant more than it's ever been, especially in today's world, you know, in our society and the way that our generation is. The days of having the company man or the company woman that works for the same company for 30 some years and then retires, rides off into the sunset with their pension. Those days are all but gone, right? We have people who are constantly changing jobs, changing career paths, especially in my business. You know, real estate is considered an encore career. It's something that people do after they've had their 30-year career as well. And so as we look at the changing landscape of how that all factors in, there's a lot more people who are starting to go into business for themselves. It's not this big, audacious, scary thing that it used to be. It's something that is kind of becoming the norm nowadays. And if you aren't going completely into business for yourself, at the very least, there's a lot more people out there who are having side businesses where they will use that income to supplement whatever they have. You know, as the world becomes more unaffordable, that is going to be the wave. And that's something that you're definitely going to see, right? You look at all of these other professions out there that have these salaries where the pace of it just isn't matching with inflation, and they have to have a side business, right? Or have to have some type of job that has some type of flexibility where they're not having to be in place at a certain point. And so, again, I definitely think that this is a trend that is continuing to go on. And so I want to discuss what that looks like when it comes to purchasing a home. I'm all in favor of having streams of income or some type of job or situation where you are not completely at the mercy of an employer who is going to do layoffs or who's going to make all these different changes and say that, hey, due to cutbacks and due to these different things, we are having to lay off half of our force, and now you're forced to figure out where do you go from here, right? And so I definitely think it's a smart move to have something else in your toolbox as a backup as well. And so I wanted to talk about how that relates to it so that you're prepared or not blindsided with the information when you go to purchase a home and you find out that it doesn't necessarily work the same for people like us who have these irregular incomes, right? So the first thing I want to go into is just the reminder of what we call the DTI. So this is the debt to income ratio. And this is very important when a lender is looking at your ability to be able to qualify for a mortgage loan. Now, if you're doing well enough in the self-employed field that you can pay cash for a house, you can ignore everything I'm about to say. But for the rest of us who are having to utilize a mortgage to get a home, this is something that's going to be very important. So I definitely want you to pay attention to this. So the way that it works is that they're always going to be looking at your debt payments and figuring out, okay, how much debt obligations do you have each month, and how does that stack up to what your average monthly income is? Now, again, because you make an irregular income, this is going to be a difficult figure for them to determine. It's not like you get paid every 2 weeks, like a traditional W-2 employer every month or so, and they can clearly see what your income is going to be from month to month. This is a situation where they're trying to have to look at the entire year as a whole, especially if you have an income that kind of goes up and down based on the seasons. They want to look at the entire year and average that out. And so they're always looking at that number saying like, okay, if we average out what they make in a year typically and divide that into 12 months, how does that stack up to their debt obligations, right? And so when they look at your student loans, if you have car payments, if you have any other things that are factored in there, right, as well as your mortgage payment that you're trying to sign up for, they're going to look at all those things combined, and they don't want it to be past a certain percentage of your monthly income average. So that's what they're always talking about when they reference the debt to income ratio. And so that's one thing that you definitely need to understand before we ever even get into the talk of what else they want to see as far as figuring out what your obligations or what your average income is. The next thing that's important is that they want to see at a minimum. And when I say minimum, I mean this is bare bones. This is, you would prefer to have more than this just to make sure that they have a firm grasp on it and you're well qualified to buy that home. But at a minimum, they're going to want to see at least 2 years of your income that you have reported on your taxes at a certain level. Right. And so, like I said, if you make, let's say, $100,000 one year and then you make $60,000 the next, they're going to look at that as an $80,000 average income. They're not going to compare it to your highest, and they won't do it to your lowest. And they would prefer to have 3, 4, 5, even 6 years or even past that of consistent income. That way they can get a better idea of it. But at a bare minimum, they're going to want at least 2 years. And so if you have recently become self-employed, right, if you've recently gotten into a new field or recently took on a part-time gig or something like that, you're going to want to make sure that you have at least 2 years of that income that you can report to use towards your debt to income ratio, right? If it's something that you just started and you had, let's say you had an amazing year, but you've only had the business for maybe 13, 14 months, that may not be enough for them to be able to put those funds into consideration when you're trying to qualify for that loan. And so that's another important thing. The other thing as well, and I talked about this when I talked about my own personal story, if you have maybe 5 years or more, if you have several years in the business, it does benefit you as well, even if your most recent 2 years may have had more of a roller coaster. If you have 5 years, they may be able to take some of those additional prior years into consideration as well. So you always want to talk to your lender to make sure. But again, at a minimum, you want to have at least 2 years at a standard income rate. The other thing to keep in mind, especially when it comes to taxes, that a lot of times when you're self-employed, you want to get as many tax benefits as possible, right? You're trying to write off different things that you may have used for the business and all those things like that. That's great. You definitely want to make sure that you're being wise and writing off as many things you can. However, you also want to be careful. Talk with your accountant, talk with your CPA, talk with whoever runs your books and how you get those things situated, because what you don't want to do is get to a point where you have written so much stuff off that the income is now dragged down and it hurts your eligibility for the loan, right? And so there may be times where you say like, hey, I could write that off, but I want my income to be as high as possible to make sure that I can qualify for this loan. Now, again, you want to talk to a qualified accountant, a licensed professional, a CPA, someone that can help you determine the best way for you to go about that. But again, that is something that can oftentimes get people, people kind of get right off crazy in a sense, right? They're writing off all these different expenses and all this stuff, and it looks like they didn't make hardly any money or hardly any of these things, and now it doesn't really impact or help their eligibility for that loan the way that they thought it would, right? And so that's always something that you want to pay attention to, is again, looking at those most recent 2 years as a baseline for determining what your income is. And if you don't have that amount of time in, you may need to wait a little bit longer to figure out or get those numbers up to an average figure so that you can use that to help you qualify for the loan. Now, in my personal experience, like I said, I'm a realtor, and I was 100% income or 100% commission based income. And so all of my income was basically up and down based on whatever my business was doing at that time. And so it was very much like hey, some months are great, some months not so much. And whatever those averages are, you can kind of take that and run with it as well. But the other thing too is that because I had an irregular income, there were a lot of things that I had to go through or had to submit to the lender or to the underwriter that most of my clients have not had to. For example, one of the things that they wanted was what they called a proof of pipeline, right? Because again, they know realtors business, it can be sporadic at times, it can be seasonal at times. And so they wanted to see, okay, we know what you made the previous 2 and 5 years and however long you had been in the business before. We know that because we can see that clearly in your tax returns, but we want to have an idea of how things are looking right now. Like, how is your business looking right now? And so I had to submit a document basically showing them like, hey, here's the buyers and the clients that I have under contract. Here's the deals that I have set to close within the next couple of months. Here's some leads that I've gotten that have been pre-approved. Like, I had to basically write out a whole list of things, just proving to them essentially that I have. Now, that wasn't in any way, shape, or form an official document, right? There was no way that I could prove. And as anyone in real estate will tell you, no deal is official. And more importantly, no commission is collected unless the deal actually closes, right? And so that pipeline could very easily disappear. It's not likely, but if any one of those deals didn't close, or if those buyers decided to wait a little bit longer, or if the listing didn't close, I walk away with nothing, right? And so that document really wasn't a guarantee of anything. But again, the lender is doing everything they possibly can to see whether or not you are a qualified buyer, right? They want to make sure that once you go through with the sale of this house, that you're not going to run on hard times and then not be able to pay back that loan. And so they may ask you, it depends, every lender is a little bit different, but they may ask you for some things that aren't typical or definitely not often asked for from other traditional buyers, right? They may ask you for like, hey, give us a rundown of what your business is looking like. If you are someone, I don't know, who's selling t-shirts, right? They want to see like, how many orders do you currently have with those t-shirts? Like, how many sales? What are your expenses looking like this year? Like, give us a P&L statement. I had to give a P&L statement. I was buying around the middle of the year, so it was around June, but I still had to give them just an updated P&L, a profit and loss statement showing like where things looked for that year, just kind of showing what income I had, what expenses I had coming up and stuff like that too. And that year in particular, at least for me, was a very weird year. It was like a backloaded year where I had a bunch of deals that were under contract or in the works, but didn't actually close until after I closed on my home. And so it was a very much a interesting concept to kind of walk through and explain to the lender, like, hey, like, I know it seems like business is really slow when you just look at the first several months of this year, but look at all these deals I got closing are on the back end of this year. And that was one thing to kind of help give them peace of mind in knowing that, like, okay, we believe that he's going to be able to qualify for this loan and be able to make this happen. And so it's definitely a lot more that's left up to interpretation. Unfortunately, that also leaves a lot more up to bias, and that can be a whole other conversation we can jump into as well, where you're really having to, or the underwriter, the lender is having to use more of their personal judgment as opposed to figuring out whether or not that person just qualifies just based solely on the numbers, right? And so it's a lot that goes into it, and then we haven't even discussed credit scores. We haven't discussed like late payments or anything like that. We haven't discussed how any of that can also come into the equation as well. They're really just looking at all of these different factors and variables to see, essentially, is this person likely to pay back this loan consistently on time every single month? And if so, can they do that for the next 30 years, however long this loan is signed up for? They want to make sure that you are a qualified buyer, and there may be different ways that they go about getting that information, right? Like I said, the document that I gave them, there was nothing legitimate about that document. It was just me writing down like, hey, here's some pre-approval letters, here's some contracts that I have under. But outside of that, I can't guarantee you that any of this is going to actually translate into money. I can tell you the likelihood of that happening, but I can't guarantee any of it. And they just have to trust and go with that and make sure that you're in the good. But they may be prepared. They may be asking you for items or documentation just to prove what kind of sales and things that you have coming down the pipe to make sure that you are currently in a good position as well. And the same thing goes, so for me personally, real estate was my full-time job, right? And so that was kind of like our bread and butter. That was the majority of it. But again, like I said, a lot of people may have it as a side business. And even then, if you're going to be able to factor those funds in, they more than likely are going to want at least 2 years of income from that side business before they can factor that in there. Same thing goes for part-time jobs, right? So if you have a part-time or a side-time job, like let's say you work at, I don't know, a random grocery store, you work at a retail store part-time, and you want to see it, but if you can use that income as well, more times than not, they're usually going to want at least 2 years of income before they can start to count that side job as well. And so again, you want to make sure that you have a firm understanding of how that works before you try to jump into things too quickly, right? You want to make sure that you have all those things that can be taken into consideration. Because it may be that your numbers are razor thin, that you don't quite qualify for purchasing that home. But if we can add in that side income, well, then now you're good to go, right? You want to make sure that is always in place. And so they may have those same requirements as far as having a good 2 years worth of income, even if it's a side job or a side business that you want to have included. It really depends on the lender that you're working with, like I said, and their judgment on it. And then also, if there's anyone else in your household whose income is also contributing to this business, right? And so there have been times too where I've had some people who thought that they were good to purchase a home and figured like, oh, my spouse definitely makes enough money for us to qualify. But then we find out that either because of the time limit rule that they have as far as like how long they've had this business or how long they've had that income, sometimes it may not be able to be factored in, right? And so I've had situations where some people were like, hey, right now we could technically buy this house and easily make this payment every single month, but because we haven't had these jobs long enough, or because the income is deemed irregular, or because we're technically self-employed or 1099s, we don't have the proof or the longevity of this business yet to prove that we can qualify for that home. And so we don't think, so like I said, I've heard of numerous situations where people were making six figures, like could easily make a payments on a house, whatever. But if they haven't had that job long enough, or they haven't had those sales long enough, they may not always be able to use that towards qualifying for a loan. Which brings me to the most important point, and the point that I always beat my drum on this every single time, is that you need to talk to a lender in early. Right? You need to talk to them as soon as you start thinking about even purchasing a home, or thinking about like, hey, this is something I'd like to do down the road. It never hurts to talk to a lender, because you want to be able to get an idea from them. Hey, how is this going to factor in? I would not trust an online lender service company to help you determine what you qualify for, because again, they aren't aware of all the things they may not even know the questions that you would need to ask in those situations. You always want to talk to an actual person, an actual lender who can walk you through it, and a lender who is familiar with the way that real estate transactions or deals work in your area. You want to talk to them and have them walk you through, okay, if you have this side job or this other business where the income is a little irregular, here's what your goals or benchmarks need to be, so that we can make sure that income is included with what you need to be able to qualify for the home that you're trying to purchase, right? You always want to talk to them, and it is never too early. As if you go back and listen to my home buying journey episode, you will see, I know firsthand better than anybody, it is never too early, and it's never a bad idea to talk to a lender just to see what you need to do, what you need to qualify for. If there's any debts that you need to pay down or get off the books, All of that stuff you want to find out as early as possible. You don't want to leave it up to a Google search to where you're trying to figure out like, oh, well, what do I need? Well, this person who bought a house in Minnesota, they only needed this when they purchased their home. No. You want to make sure that you know exactly what your lender, the lender that you plan on using, what they want. You want to make sure that that is going to work in your area. And you want to make sure that you have all the information so that you're not going under contract, putting thousands of dollars up front at risk, and then finding out that you don't qualify to purchase that home. And now you've not only have you lost out on that opportunity to buy the home you wanted, but you've also lost out on thousands of dollars as well that you had to put up front just to get that home under contract, right? And so these are all things that you need to be paying attention to, have a firm understanding and a firm grasp on. I don't want to scare you to think that, oh, this will never happen, or that it's not in the cards for you if you want to buy a house and you're self-employed or having a regular income. But I do want to make sure that you are adequately prepared for the things that the lender is going to expect and request from you. If you ever have any questions, I'm always happy to walk through this with you. I'm never going to step outside of my lane to try to tell you something that I think is work best. I'm always going to make sure that I put you in front of the professionals, right? The people who understand exactly how this works so that they can put you in the best position possible. I hope that that's helpful for you all. Have a wonderful day, and I'll talk to you next week.